Hey everyone, welcome to this channel at X World Training Institute. This is yet another video in our IGCSE accounting playlist. If you haven't watched the other videos yet, please do watch. I've made the videos in the series in the order in which the syllabus is arranged. So today, this is a video on depreciation. How do we calculate depreciation? How do we do accounting for depreciation? I've received a lot of requests to post a video on this topic. So let's do this video today. If you have not watched the previous video on how to differentiate between revenue and capital expenditure, I would suggest please do that. Please watch that video. I would put the link in the description box below. Once you watch that video, this video will make more sense to you. So let's see what are we going to learn today in this video. First, we understand the cost of the asset. What is cost of the asset? Previous video we've already discussed how do you calculate the cost of asset and the capital expenditure. Then we understand the meaning of depreciation. We understand what is accumulated depreciation and the net book value of the asset. We understand the meaning of these terms. Then we go ahead and understand the different methods of depreciation. In our syllabus we have mainly three methods. We have the straight line method, the written down value method, which is also known as reducing balance method, and the revaluation method of depreciation. We see some examples on how to calculate depreciation and then some theory behind depreciation, which is also as important as the questions. If you understand the reasons for the fall in value of non-current assets and the importance of depreciation, why are we providing depreciation accounts, it will make more sense to solve depreciation questions in exam also. Okay. So this video will be mainly on understanding the meaning, concepts and calculation of depreciation. In the next video, we'll see in detail how to do accounting for depreciation. And finally, there will be a third video where we understand how to account for disposal of non-current assets when the asset is sold. So, meaning of depreciation. Okay, what is depreciation? When a capital expenditure is incurred, we get a non-current asset in return. Now, capital expenditure, that is purchase of non-current assets, cannot be treated the same way as revenue expenditure. Under revenue expenditures, whatever expenses we incur, we transfer it to the income statement of the same year. But in non-current assets, we cannot transfer the entire value of the non-current assets to the income statement in the same year. We'll have to break down the entire value of non-current assets, transfer them proportionately to the income statements of various years. Okay. How do we know how much amount to transfer to the income statement? Basically, based on the benefit gained from the asset in each year. Okay, for example, if you pay salary to an employee who works for 1 month or for a year, you transfer it to the income statement of that year because that employee or the salary paid to the employee has helped you earn revenue for that 1 year. But when you buy a machinery, the intention is to, let's say, use it for next 3 or 4 years. So we break down the cost of the asset in such a way over the next 3 or 4 years, so that when we transfer it to the income statement of each of these 4 years, we are trying to match it with the benefit or with the revenues the asset has helped us to earn. Okay, it will become more clear as we go ahead in the video. So I would insist, please watch it till the end to understand the entire concept of depreciation. Okay, so what is depreciation? Basically, depreciation is that part of cost of the asset which is charged as an expense in the income statement of the current year. So you have the entire cost of the asset. If I break it down into parts, whatever part I'm transferring to the income statement of this year, that is depreciation for this year, or you can call it annual depreciation. So let's say we have this asset. You could assume it as a machinery, an equipment, a furniture. The cost of the asset was 6,000. And the useful life is 3 years. Estimated useful life, we estimate that we will be able to use it for the next 3 years. If you're going to use it for the next 3 years, it means it will help us generate revenues for the next 3 years. So it wouldn't be fair or it wouldn't be right to transfer the entire cost 6,000 to the income statement of year 1. Hence, what do? We break down the asset into 3 parts, or we break down the cost of the asset into 3 parts. And each of the year, we transfer one part to the income statement of that year. So in year 1, I'll transfer 2,000 to the income statement as expense, which is depreciation. In year 2, I'll transfer another 2,000. In year 3, I'll transfer another 2000. In total, over the 3 years, I'll be transferring 6000, which is the total cost of the asset. Now, in year 1, 2000 was the annual depreciation for that year. In year 2, another 2000 was annual depreciation for that year 2. Same way for year 3, annual depreciation was 2000. Before we go to different types of or different methods of calculating depreciation, some important terms have to be understood, which are also used in the financial statements when preparing the income statement and balance sheet. So, first term is cost of the asset, which I am sure if you watched the previous video, you would be aware of. What is included in the cost of the asset? The purchase price of the asset, all expenses that you've incurred before you can put the asset to use. Your freight on your asset, your custom duties on your asset, your installation charges, your legal charges, all these expenses, if I take a total of them, expenses incurred before the asset is actually put to use, if I take a total of them, I get the total cost of the asset. Cost of the asset is amount that you paid upfront to acquire the asset. Second term, depreciation for the year, also known as annual depreciation. I've told you, annual depreciation is that part of the non-current asset which you're transferring to the income statement in the current year. Then accumulated depreciation. Now, accumulated depreciation means till date, whatever I've transferred to the income statement as depreciation, that is accumulated depreciation. Not only for this year, all previous years. So, till date, whatever has been transferred to the income statement as depreciation, that is known as accumulated depreciation. And finally, we have the net book value. Net book value is that part of the non-current asset which is not yet transferred to the income statement as depreciation, considering all the years. So if I have total cost of the asset, if I subtract the total depreciation transferred to the income statement till date, I get net book value, which is amount not yet transferred to the income statement. So let's see a quick example to understand these terms again. Now let's say first year I calculated depreciation 2000, which I will transfer to the income statement. So my first year cost of the asset is 6000. Depreciation for the year was 2000, which I transferred to the income statement of year 1. So after I do this, total depreciation till date transferred to the income statement is obviously just 2000. And what is the net book value? Out of 6000, 2000 has been transferred to the income statement. So what is remaining is net book value. So 2000, which is nothing but 4000. Okay. So going to year 2, we will have another annual depreciation of 2000 in year 2. Cost of the asset remains same, 6000. Cost of the asset does not change. It remains the same every year. 2000 is depreciation for year 2, hence we transfer it to the income statement of year 2. Now what will be the accumulated depreciation? Accumulated depreciation will be 4000. 2000 transferred in the previous year, 2000 transferred in the current year. Total depreciation till date. So eventually, what will be the net book value? Amount not yet transferred to the income statement, which is this 2000. Okay, I hope it is making sense. Now, final year, third year, again I transfer another last installment of 2000 as depreciation to the income statement of year 3. So that makes annual depreciation of year 3 as 2000. Accumulated depreciation becomes entire 6000. 2000 year 1, 2000 year 2, another 2000 year 3, total 6000. Since entire cost is already transferred to the income statement as depreciation, accumulated depreciation is now equal to the cost, hence net book value is 0, meaning there is nothing more left to be transferred to the income statement as depreciation. So, important terms that you have to note here: cost, depreciation, which we can also refer to it as annual depreciation, accumulated depreciation, and net book value. Okay. So let's see what are the different methods we have for calculating depreciation in our syllabus. First one is straight line method, very simple method. The meaning of straight line method is simple. It says that the amount transferred to the income statement as depreciation should be same every year, equal depreciation. Every year you should transfer the same amount of depreciation to the income statement. That method is straight line method. So important feature about this method is that at the end of the life, or at the end of the useful life of the asset, the net book value eventually becomes 0. We've seen in the previous example. At the end of year 3, net book value became 0. So straight line method, where depreciation remains same every year. Second method we have is reducing balance or written down value method. Now in this method, the important feature is depreciation amount keeps on reducing every year. Whatever it was in year 1, year 2 will be lower than that. Year 3 would be even lower. Year 4 would be even lower. Now, important feature here is that net book value will never reduce to 0. It will keep on reducing. It will become a very small number, but it will never reduce to 0 in reducing balance method. And finally, we have the revaluation method for assets where straight line method and reducing balance method cannot be used, or it's not suitable to use the above two methods. There we use revaluation method. How do we use it and examples of some asset where we can use revaluation method we'll see a little later. Okay, straight line method. Let's look at the formula, how to calculate straight line method of depreciation under straight line method. Now, annual depreciation, we have a formula given in the syllabus: cost minus residual value divided by the useful life. Cost is the cost that you've paid upfront for acquiring the asset. Residual value is the estimated residual or estimated scrap value which you think the asset could be sold for after you've used it for its whatever is the useful life. Okay, whatever is the estimated scrap value, that we will subtract from the cost, and finally divide it over the estimated useful life. If you feel that the machinery can be used for another 4 years, divide the cost minus residual by 4 years. This gives us a number which is the annual depreciation to be transferred to the income statement every year. Let's look at an example. For this example, cost of the machinery is 16,000. We purchase the machinery for 16,000. According to us, we will be able to fetch $1,000 after we've used it for 5 years. So estimated scrap value is 1,000. So using this formula, we would get an annual depreciation of 3,000. 16,000 minus 1,000 divided by 5, we get 3,000 would be your annual depreciation every year. Okay. For straight line method, there is another alternate formula available, which is your cost of the asset, whatever you acquired it for, multiplied by a rate of annual depreciation. Now, there is a specific rate that we'll be using to calculate depreciation every year, which will be given in the question. You multiply the cost with this rate, you get your annual depreciation amount. Again, we look at an example. Let's say we purchase a machinery for $20,000 and the rate of depreciation given is 20%. So multiply the cost by the rate and you get your annual depreciation as 4,000 per year. This was straight line method. Again, how do you know it's straight line method? Because the depreciation amount is same every year. In the previous example, it was 3,000 per year. In the next example, it is 4,000 per year. Going to the second method, reducing balance method or written down value method. Now, reducing balance method, the depreciation amount should keep on reducing every year. How does that happen? There's a specific formula that you need to use to calculate depreciation under this method. The formula is whatever rate they want you to use, the question wants you to use that rate multiplied by the net book value. Recalling, net book value is cost of the asset, whatever you've purchased it for, minus accumulated depreciation on that asset. Whatever depreciation till date has been given, you subtract, you get net book value, multiply that by the annual rate, you will get your annual depreciation. Now let's look at an example to calculate depreciation under the reducing balance method. So let's say we purchased the machinery for $5,000. Annual rate of depreciation given is 20%. Let's see how to calculate depreciation. We'll be calculating depreciation for the next 4 years. First year, our cost of the asset is $5,000. Accumulated depreciation is obviously 0. No depreciation has been given in any of the previous years. So net book value, take a difference, you get 5,000. 5,000 into 20%, you get annual depreciation as $1,000. First year, done. Second year, cost of the asset remains same. Now, accumulated depreciation, $1,000 comes from here, annual depreciation of the previous year. Only 1 year is passed, so that 1,000 becomes accumulated depreciation. If I take a difference of cost and accumulated depreciation, you get net book value of 4,000. 4,000 when multiplied by the rate of 20%, you get $800. Same way, third year, cost remains the same, $5,000. Now, accumulated depreciation is depreciation provided in all previous years. First year 1,000, second year 800. Total becomes 1,800. 1,000 plus 800. If I take a difference, I get 3,200, multiply that by the rate, depreciation would be 640 for year 3. And finally, year 4, 5,000 cost, accumulated depreciation, total of year 1, 2, 3, I get 2440. If I take the difference, net book value will be 2560 multiplied by 20%, you get 512. So this, if you see, the annual depreciation is reducing year after year, 1,800, 640, 512. This is an important feature of reducing balance method. Depreciation keeps on reducing every year. Okay. Now, we've seen a very simple example on how to calculate straight line and reducing balance method. We'll look at some more examples a little later. Now, for some assets, these two methods cannot be used. Why? Because when you're using straight line method and reducing balance method, you need to keep accurate records of your assets. What asset exactly has been purchased? How much was it purchased for? What was the date of purchase? You might have to maintain registers. You might have to maintain proper records. Now, there are some assets for which maintaining these type of records is not feasible. It doesn't make sense because these assets are very small in value and they rotate too frequently. So the effort required to maintain these records would be much higher than the benefit that this activity would give you. So for such assets, we use a very simple method of calculating depreciation, which is revaluation method. Now, what's the formula for revaluation method of depreciation? You take the opening value of the assets at the beginning of the year, how much value of assets you had, add the assets you purchased during the year, fresh assets purchased during the year, and subtract the closing value of assets at the end of the year. How do you get the closing value of the assets at the end of the year? You need to take a stock of all your assets. You need to see which of these assets are not in usable condition and not fit for use further. So whatever assets can be used, we attach a value to them based on their current value, and finally we get a closing value of the asset. So using this formula, you would get the annual depreciation or the annual usage of the asset. So for example, like tools or spare parts. So what are the different assets where we can use this method? One of them is tools, spare parts. Now if you notice, these assets are not assets for which you would want to maintain detailed records, because first of all, rotation is too high, you purchase them too frequently and they wear off too frequently, plus the value would be too small for you to maintain proper records. Okay, so let's say the value of tools at the beginning of the year you had was 1,200 worth of tools you had at the beginning of the year. During the year you purchased 5,000 worth of tools. So 1,200 plus 5,000. It means during the year I could have used or consumed tools worth of 6,200 for my business to earn revenues. Now when I come to the end of the year, I see that whatever tools are left in inventory, whatever tools are left in the inventory, the value of those tools comes to 900. So can I say that if I exclude the closing inventory of the tools, I can say that 5,300 worth of tools was consumed during the year. Now this is depreciation based on revaluation method. So tools consumed during the year would be 1,200 plus 5,000 minus 900, $5,300. And it makes sense also because these tools of $5,300 we've used to earn revenues during the year, and hence we transfer this amount to the income statement. Okay. When is this method used? This method is used when it is not possible to maintain detailed records of individual assets of the firms. Now, for your syllabus, there's a typical example, there's a typical adjustment that you need to learn, the date of purchase. Now, the method and the formula is fine, but the area where students make mistake is where the question makes it, the question gives you an adjustment that the date of purchase is important, the date of purchase is not important, you have to ignore the date of purchase. Let's see, what does it mean? Very simply, in the first year when you purchase an asset, okay, let's say you purchase an asset, let's say it's just one more month left for the year ending date. You purchase an asset, you purchase a machinery, and the annual rate of depreciation for that machinery is 20%. Cost of the asset was 10,000. So I have 10,000 cost. Annual rate of depreciation is 20%. That gives me a depreciation of $2,000. But have I used that machinery for the entire year? No, this rate of 20% is usually per annum. So by that logic, 2000 depreciation cannot be given for just using the asset for 1 month. Hence, we need to calculate depreciation pro rata based on the number of months you used the asset for. So into 1 by 12. This is a very simple example. Okay, so let's look at an example. A firm with a year ending date on 31st December acquired a machinery costing 25,000 on 1st April. Calculate depreciation expenses for 3 years using straight line method. Depreciation rate is 20%. Now, there are two types of situations that can be given to you in the exam. One would say that provide depreciation from the date of purchase till the year ending date, what we've done here. Only for the part of the year that you've used the asset, only give depreciation for that period. But there's another situation that can be given to you. They might say that ignore the date of purchase. Don't look at when the asset was purchased during the year. Assume that the asset was used for the entire year and provide full year's depreciation. Now, why would a firm do that? Basically to avoid calculation, to avoid difficulty in calculation. They want to make it very simple. If we purchase the asset during there, we'll give full depreciation and we will not get into the calculations of number of months. Just for the purpose of simplicity of calculation. That's it. So in exam, you could be given any of these situations. Let's see how we would deal with them. So first situation where depreciation, the question tells you that provide depreciation from the date of purchase till the year ending date. Now, depreciation year 1 would be the cost of the asset, which is 25,000 multiplied by rate, but only for 9 by 12. Only for 9 months. Why? Because I purchased the asset on 1st April and my year ending date is 31st December. The only 9 months of period has lapsed between the date of purchase and the year ending date, and hence I will do multiplied by 9 by 12. So I get a depreciation of 3750. One very important point here, common mistake made by students, they feel that straight line method is a method where depreciation remains same every year. So this 3750 they would give next year also. They would, without making any calculation, they would say that depreciation for year 2 is 3750 because depreciation remains same every year. That's not true. First year we had done pro rata calculation. That is only applicable for the first year. It is not applicable for second and third and fourth year onwards, because it's only in the first year that the asset can be used for a part of the year. Every year you can't use it for part of the year. From second year onwards, you always use it for the full year. So from second year onwards, you don't need to do any calculations for time. Directly cost into rate, so gives you 5,000 for year 2 and year 3. Now second situation where the question tells you ignore the date of purchase, meaning they don't want you to pay attention to the date of purchase, just provide full depreciation without giving any importance to when the asset was bought. So in the first year, the only difference is I will not do the time calculation. I will not do pro rata calculation for time and calculate depreciation for the full year. So cost into rate gives me 5,000. Second and third year will obviously be 5,000 because the calculation of time is just applicable for the first year. So keep in mind these two situations. Definitely in the question they will mention this, whether they want you to calculate depreciation from the date of purchase till the year ending date or for the entire year without giving any importance to the date of purchase. Okay, let's look at the same situations but in reducing balance method. A firm with a year ending date on 31st December acquired an equipment costing $120,000 on 1st of May. Calculate depreciation expense for 3 years using reducing balance and rate is 40% each year. Situation 1 where they tell you that provide depreciation from the date of purchase till the year ending date. So depreciation in year 1 would be your 120,000 multiplied by rate 40% multiplied by 8 by 12. Why 8 by 12? Because you've used it from 1st May to 31st December, only 8 months. So you get 32,000. Second year onwards, now this is reducing balance method. This is not straight line method. So I can't do 120,000 into 40%. How did I get this 88,000? Cost 120,000 minus accumulated depreciation of 32,000 that was given in the year 1 gives me 88,000. That 88,000 is net book value multiplied by rate 40%. You would get 35,200. Coming to year 3, again, your cost is 120,000. What is accumulated depreciation? 32,000 in the first year, 35,200 in the second year. Total gives you depreciation provided till date is 67,200. If you take the difference, you get net book value of 52,800. That multiplied by rate of 40% will give you annual depreciation for year 3. Again, in year 2 and year 3, we have not done any calculations for number of months because that is only applicable for the first year. Now, second situation where they tell you ignore the date of purchase, depreciation in year 1 would be 120,000 into 40%. We don't have to multiply it by T upon 12, which is time upon 12. So, annual depreciation for first year is 48,000. Year 2 and year 3, same way you have to calculate the net book value, which comes to 72,000, and then year 3, 43,200 multiplied by the rate, you will get your annual depreciation. Now let's understand the importance of this concept of depreciation. See, depreciation is not a difficult topic. The problem is students just directly jump to the past paper questions to just solve depreciation questions without getting a background or theoretical background of the concept. It is very important to understand why are you giving depreciation, why a particular method is chosen, then only it will make sense to do the questions. Let's understand the reasons why depreciation is important. There are two main accounting principles that form a base for providing depreciation. One of them is the matching principle. Now, matching principle means that you need to match your expenses as accurately as possible with the income or revenues earned. Okay, so when a non-current asset is purchased, what happens if you transfer the entire cost of non-current assets to the income statement in the first year itself? That's not correct because that non-current asset will help you earn revenues for the next few years. If you transfer the entire cost to the income statement of the first year itself, you are understating your profits because your expenses would be very high, and that would not be real. Same way, if you don't provide depreciation, what would happen? A part of the asset has helped you earn revenues during the year, and you're not giving depreciation or not charging expenses for that in the income statement. You are understating your expenses, and hence your profits will be overstated. So calculating depreciation and providing it in the income statement helps you correctly match your expenses with the revenues and eventually help you calculate the correct net profit for the year. And another accounting principle that forms a base for calculation of depreciation is prudence principle. Now, prudence says that you should never overstate your never overstate your profits and never overstate your assets. Let's say you've used machinery for 3 or 4 years without providing any depreciation. What would happen in your balance sheet? You would continue showing the asset at the cost. Let's say you purchased it for 10,000 originally. After 4 years also it will be showing it at 10,000. But is it right? After 4 years, after using the machinery for 4 years, will it still have a value of 10,000 in the market when you go and sell it? Definitely no. So if you're not giving depreciation and showing the asset in the balance sheet still at 10,000, you are overstating your assets, which is against the prudence principle. Same way, if you're not charging depreciation every year, you are overstating your profits because your expenses are understated. That is also against the prudence principle. Prudence principle does not allow you to overstate your profits and your assets. Now let's understand why is depreciation happening. What are the reasons because of which non-current assets are depreciated? I told you, right, the asset that was purchased for 10,000 in year 1, after 4 years, its value is not 10,000. Now, why has the value declined? Why is the value of the asset declined? There are certain causes of this decline that you need to understand. The first and one of the most common causes of depreciation is physical wear and tear, physical erosion of the asset. Now, this is mainly for assets like machinery. You use the asset. Physical wear and tear is there. There's a limit to how much of the asset you can use. Okay, if you've used that asset to produce a lot of units, a lot of products, obviously there will be wear and tear, and eventually the machinery or the asset will wear off, and you will not be a usable condition further. So physical wear and tear is the first cause. Second, some assets don't wear off physically, but they become obsolete in nature. For example, you buy a laptop, you buy a computer, a mobile phone, or any technological item. Now they don't physically wear off so soon. They can be used in a good condition for next 3, 4, 5 years. But does the technology last for so long? No, it becomes obsolete maybe in 1 year, 2 years. So once the technology is obsolete, that asset has no value left. So another cause of depreciation is fall in the economic value, even though physical wear and tear is not there. Third cause of asset is time or duration. Now, some assets are there with the business for a specific period of time. For example, a leased premise. If you've bought a premise on a long-term lease, okay, for let's say 20 years, and you've paid an upfront cost of let's say 100,000 for 20 years, annual expense comes to $5,000. 100,000 cost divided by 20 years. Let's say you don't use the asset for first year, second year. Obviously, there is no physical wear and tear, but time has decayed, time has passed, and and you've still paid money, or you still paid value for that time, you still paid cost for that time. So depreciation is still happening. So some assets depreciate based on time. And finally, some assets, especially natural resources, depreciate because of depletion of assets. So let's say we have a oil and gas well, we have coal mines. When those mines or when those wells are full of assets, when the mine is full of coal, value will be high. But let's say you've extracted a lot of coal out of the mine for last few years. Now, the coal inside the mine, the asset inside the mine has depleted. So the value of the mine won't be the same as it was many years back. So because of extraction of natural resources, the value of assets also deplete, and hence we need to provide depreciation. So these were the four common causes of depreciation. In the next video, we will see journal entries regarding depreciation, regarding purchase of assets, regarding depreciation, how to make ledger accounts. Using the calculated amounts of depreciation, where do we put it in the account? And finally, another third video we will have on disposal of non-current assets. If you think that the video was useful, please like the video, please leave down your comments below, leave down your doubts below, please share the video, and I will see you in the next video. Thank you.